Hey, my name is Zane Stedich. I'm going to be giving a presentation on the rates of return in private and public markets, and I have Dion with me who's going to be asking some questions at the end and hopefully answering some of the questions that you guys would have had if I presented this in person. Um, so a quick overview is we're going to go over private equity performance as well as uh, public performance, and then compare the two and talk about the situation concerning IPOs and some of the problems that are going on currently, and then conclude from there. So, as far as private equity performance goes, there's actually a giant obstacle in measuring performance of PE, and that is the fact that a lot of these companies are exempt from publicly disclosing their financial forecasts, quarterly earnings, and so it's not that clear. And so there's very much a gray area because it depends on how you measure it, whether it's equal weighted basis, capital weighted basis, et cetera, et cetera. Not to mention that private equity can be very hard to invest in just because it requires a lot of capital. So regardless, it simply depends on who you ask because just like any investment, investments, it's going to be a case-by-case scenario as far as your return on investment. So to give you guys an idea of just how complex it can be, I want to touch base on some of the ways to calculate private equity performance. Some of these go, we have distribution to paid in, also known as DPI, as well as internal rate of return. And internal rate of return is also known as IRR, and it's used to estimate the potential profitability an investment could be. It's not necessarily the actual return, from my understanding. And the private market equivalent, also known as PME, is used to calculate the IRR, but alternatively, and puts it in reference to a benchmark. And one of the biggest questions to consider when you're calculating using PME is, does this reference benchmark accurately represent the cost of investment? And there's actual multiple versions of PME, such as PME Plus and MPME. And there's many other ways to calculate private equity performance as far as direct alpha and other ways that are just super complex. But moving forward, let's get into some data. And on the right here, we have a table from Cambridge Associates 2019 third quarter report. And if I'm not mistaken, Cambridge Associates actually created the MPME way of calculating private equity. And so it compares it to the Russell indexes as well as the S&P 500 index and the All Country World Index. And if you look closely, it outperforms all the public markets, even though, you know, in the 10-year Russell Midcap Index, it does come close. But this chart definitely indicates saying that private equity outperforms public equity. And so, but the problem with private equity is that in the early stages, it tends to underperform compared to the NASDAQ composite index, just because you're dealing with mostly newer companies as far as private equity. They're smaller, they're not as big, and on average, leveraged buyout funds return slightly less than the S&P 500. And this is a little chart I found, or table, that actually contradicts what the previous table showed. And it says that the public equity returns outperform the private equity returns, both on arithmetic and geometric average. And so, like I said earlier, there is going to be a gray area where it depends on who you ask, how you're measuring those returns and whatnot. So let's talk a little bit more specifically just on public performance. And so I thought it would be a good idea to look at the S&P 500 and the SPY ETF to go over the public market performance, because the S&P is used widely around the world to as a market indicator or market measure by many investors and traders. So up here we have a total return percentage dating back to 2009, and down below we have a chart of the SPY ETF going back to 1995. And so if you look at last year in 2019, there was a 31% annual return, but 2008 there was a negative 4.5 almost. And so if you look at the chart, there's always going to be dips, there's going to be recessions, there's going to be pullbacks. And so I don't really think it is appropriate to look at just the annual return, because it just depends on where the year falls in the patterns of the market as a whole and where the market's headed. So it's better to look at the S&P long-term average, and that is a little bit over 9% at 9.24%. So a little bit more about year-to-date IPO performance, something a little bit more current, is that right here we have a chart from January 1st, 2020, including the recent crash due to COVID, and comparing the S&P 500 and the Renaissance IPO index. And you can notice that the S&P 500 has yet to go positive, but the Renaissance IPO has gone positive already in 2020. So talking about just comparing the two for what they are, we have IPOs, initial public offerings. If you are a company and you are deciding whether to go in an IPO direction or a private equity direction, some of the pros for going in an IPO direction is that you get public exposure just due to the fact that you're in the public's eye, and you can generate new investors. But this can also be a con, because you have day traders just trading on the public market, and so that public exposure can work against your favor as far as your share price and bad news. So and they can also be just have increased costs. But IPOs are arguably safer, obviously depending on who you ask, but they do provide liquidity for investors if you are investing in public markets. And if you look at going into a private equity, there's lots and lots of pros. You have flexible funding. The board will supply enormous growth just due to the fact that there's going to be expertise and connections, because it's a little bit more hands-on within the investors, because they have management incentives. They want you to succeed. So, and like I said earlier, with private equity, it's hard to invest. There's a lot of capital that goes in. So these VCs and other private equity investors are more willing to throw cash where it's needed in order to promise a good return. And so, of course, there's cons, just like the third party involvement. It can be a good thing. It can also be a very bad thing. It could completely destroy your return or investment. It really just is a case-by-case scenario and what you as a company would want to do, or you as an investor would want to invest in. And so next I want to talk a little bit about some of the problems going on with IPOs right now in the current situation. So right here, we're going to be talking about the IPO's track record, specifically before, during, and after the dot-com bubble in 2000s. So initial public offerings are generally newer or smaller companies just joining the public stock market to be traded on and get funding. People usually start out with private equity and then move on to IPOs. But because of the dot-com bubble and all of the new companies starting out, and all the hype building and companies putting .com at the end of their name, even if they didn't have a website, this increased the IPOs, as you can see, with 520 IPOs per year on average leading up to the bubble. That actually later fell by a third post the bubble once it popped. And this chart right here is asking the question, did online brokers help undermine the US equities market? Because at the same time, while IPOs were on the decline, online brokers were popularized, and that could also lead to volatility, a lot of emotional trading, a lot more trading without struggle just at the home of your computer. Everything was just not on paper anymore. And so with everything going on in that time, it just wasn't a really good mix. And so what ended up actually happening, if you look here, is that with less IPOs joining the market, it leads to the question of like, what is economic growth going to be like? Because there's no new companies to invest in. And so these big companies kept buying out these smaller companies, or just completely destroying them as far as competition. And so they never really had a chance to grow. And in turn, that has had venture capitalists hesitant to invest in innovative yet risky ideas. So there's little pioneers in new industries and technologies, and not only should this concern the economy, but also the just science field and how we are headed as far as technology. So there's definitely not a lot of things perfect going on with the public market right now. It's a very manipulated market currently, but this is from an article in 2009. He just said that deals under 25 million have pretty much gone the way of the dodo bird, meaning that they are extinct because the IPOs are just not happening as much as they used to. And so here's a new chart, and this chart is actually a little bit more recent as far as IPOs filing. Going back to 2011 and to current, instead of looking at the 2000s timeline. So as you can see, we kind of recovered, actually, not completely, not to the point to where we're averaging that 520 IPOs per year. But we did get up close to there just in the 2010s. Hopefully this has helped our economy, but just recently with the new crash, you can see there hasn't been a lot of IPOs this year, but it's also hard to tell because it's only the second quarter. And so what this has led to is that companies end up staying private. When small IPOs disappear, it's fair to say that the market has something fundamentally wrong with it, and people are scared of it, you know? And so a lot of companies just stay private. And so we have, it's actually not labeled, but this is the volume of private equity deals, and this is just private equity deals. And as you can see, it's just increased over the years as compared to IPOs declining. And so as a conclusion, as far as private versus public performance, it really depends on what you are willing to do as an investor. What's your risk tolerance? Are you in it for the long game? Do you need liquidity? Are you wanting certain returns? Do you have a lot of money? And you have to ask yourself these questions. But and it, like a lot of public with public equity and performance, you're getting paid in stock accumulation, while opposed to private equity, you're most of the time being paid in distributions. And so if I had to say, the general consensus would be that the popular opinion is that private equity returns do return more, but on the flip side, it's hard to tell, and it's a case-by-case scenario because you're dealing with these companies that are not Disney, they are not Netflix, and so they're just not as popular. But if you have faith in them and you know that they are going to return that money and investment to you, then by all means, I believe PE could be a great alternative to the public equity as far as returns, just due to the fact that you have possibly more control. And also just that IPOs are on the decline, and this worries a lot of people. And although it got a little bit better after the dot-com bubble, we look at today's market and it is very manipulated. You can see that the S&P 500 is it's lost its momentum since bouncing up from the initial crash, and there hasn't been a lot of IPOs in general since then. And so there's just not a lot of innovation going on. People are scared to invest because they're simply just not those Fortune 500 companies that you would know and be a little bit more certain about your returns. So it really cuts the little fish out. And so with that being said, Dion, do you have any questions?
Yeah. So can you explain a little bit more what S&P means?
Yeah. So essentially what the S&P 500 is, not only is it an index, but it's also an ETF. And I guess if you are a beginner, it's better to me to explain just the ETF side. An ETF, in short, is just a stock, but is a stock that allows a lot of diversity, being that it owns or takes into account other stocks. So there's ETFs for just technology industries. There's ETFs for consumer goods and whatnot, and miners, gold ETFs and whatnot. But this S&P 500 is the best performing ETF, and it is used to measure the market, to say the least.
Okay. What does ETF stand for?
Exchange traded funds.
Thanks. What are some things you've learned from your research?
Well, I've learned a lot, but it definitely makes me question just public markets, even though private equity is so mysterious. It's a puzzle. The IPO situation does kind of concern me. That research I did definitely made me feel just interested on where the public stock market is headed. Just because if, growing up in America, you think that the stock market's always going to go up because historically that's all it's ever done. But if you look at a country like Japan, I'm pretty sure their stock market peaked in like 1984. And so if there is a fundamental problem with public markets, I'm interested to see how it plays out and just how investing, even starting like an IRA, will be for retirement when stocks just don't simply go up.
Okay. So I know a lot of people in the class probably have stock and all of that. Do you?
Yeah, I have some equity in multiple companies.
How has COVID-19 affected you?
Well, it definitely didn't help as far as, the value of the portfolio I have. It's nothing big, I'm only 20 years old, but it could be completely detrimental. But you also have to take it as a opportunity to invest because those stocks are cheap and we are going to recover. And so I have done that, and I have seen returns since then. But I know completely that it has obliterated people's retirement accounts, their bonds, and the market right now is in a very weird position. Actually, mostly what I've been doing for the past 5-6 months have been day trading, doing options, not always buying shares for the long term, but I definitely do that.
Okay. That's all the questions that I have. Oh, actually, I have one more question. How has private did by COVID-19? Because it seems like public IPO has been affected tremendously, but how is private equity?
I think just because, I mean, if it's affecting the public market, I mean, the stock market isn't always representative of the economy. We could have a completely dead economy, and I don't think the stock market would necessarily go straight down,
Mm-hmm.
because I think it's a manipulated market, and investors are always going to buy and buy and buy. But it's not so much about the public market versus the private market and private companies. It's more so about just how it affects business as a whole. I would imagine it at least affected private equities at least a little.
Yeah.
Yeah.
Okay. Good job. You did good.
Thank you.
No problem.